Welcome back. Well, the stock we're looking at right now is Greaves Cotton. Now, there was so much excitement at the Auto Expo yesterday, and Greaves Cotton was not too far behind. They're looking to enter a new growth phase in 2023 with products across categories and price segments within the electric vehicle space. The company has a robust new roadmap for electric 2- and 3-wheelers and has launched a range of their new EV vehicles at the Auto Expo. They've also announced that they will be investing 1,500 crores in the e-mobility business that now contributes over 40% to their overall business. Nagesh Basavanhalli, the Group Chief Executive Officer and Managing Director at Greaves Cotton, joins us now to talk about that. Nagesh, good morning and thanks a lot for joining in. You know, this business is growing at a really fast pace, the e-mobility business for you. But I'll come to the growth trends in a bit. First, about the 6 new electric 2- and 3-wheelers that you showcased yesterday under the Ampere brand. Can you tell us when do you plan to launch these and what kind of monthly or quarterly run rate are you looking at?
Good morning. Good morning, everybody. Thanks for having me, Sonia. At the outset, we are guided by our purpose of democratizing sustainable mobility. I think we've talked about that in the past. Given that yesterday, to your point, we introduced 6 new products, 3 in the 2-wheeler and 3 in the 3-wheeler, both in the B2B and in the B2C. So it caters to different audience, different customer segments and product segments. Regarding timing, the Primus, which is a foray into high-speed 2-wheeler, the Primus will be open for bookings through our 700-odd dealer outlets in the country as of today. And it will be available in the market this quarter. The rest of the vehicles will follow over the next fiscal year, over the next couple of quarters. So Primus right now and others to follow.
All right. Just one follow-up there. You know, in Q2, you hit a record high in terms of 33,000 units that you sold, both for 2-wheelers as well as 3-wheelers. Can you tell us, is this a run rate that you can sustain? Was it just pent-up demand, that was kicking in? And now that things normalize, there are some new safety norms, emission norms coming through, so prices may go up as well. Do you see demand sort of tapering off a bit?
At the outset, the demand stays consistent. Now, by us adding more products and going after more customers, right? I think we are confident on the demand, Sonia. Because if you look at it, what have we done so far? We have invested in manufacturing. So our capacity today is 250,000 units on a single shift and going up to 500,000 as needed, right? We have invested in design and styling and technology made in India. Engineering and styling made in India, right? So invested in products and people. So what that means is the fundamental foundations are in place. The market demand, to your point, I think is sustainable. Keep in mind, you touched upon the RECs. The battery, we welcome the battery standard RECs that have come in. December 1st was the phase 1. April 1st will be the phase 2. And so short term, you will see blips, meaning when this introduction happens, you can see a 1-month blip, but over a period of several quarters or over a period of a year, we expect demand to continue.
Hi Nagesh, good morning. Good to speak to you after a while. So you're going at a run rate of around 11,000 units per month, but your capacity, as you just mentioned, is a little over 20,000 units per month. Could you tell us by when do you see you moving to that capacity, say by early FY24? Do you think you could do that? And also the ultimate aim is to go from 250,000 to 1 million. Phase it out for us. Time-wise, how do you see this happening?
So Nigel, good morning. As you recall, we were at 125. Just in recent times, we increased the capacity to 250, right? Anticipating this, and it's not just us, it's also the supply chains that have to be ready, right? So I think, the 11,000 or the 33,000 average quarterly run rate that you talked about, right? We anticipate that to continue to grow. And when you look at the trend, right, we were doing 2,000 vehicles a month just about 14, 15 months ago to kind of where we are right now, right? So I think that trend line you will continue to see. The new products that we have added, right, especially the Primus goes after the high-speed segment, the greater than 75 kilometers, the higher performance, different type of customers, the NX and the NG, which is our next generation style vehicles, again goes after different sort of customers. So we are doing everything in our power to kind of get ready with the demand and the foundation. I think as the market picks up, we believe the trend should be in the right direction. Keep in mind, Nigel, one or two quick things that I want to add. The industry has gone through chip shortage in the last 1 year, supply chain issues in the last 1 year. Some of the, if I can say, the worst is behind us. And now with the battery standards also getting in place, we believe, and with the supply chain and financing, which is a key indicator in this business, bank financing is also picking up. Some of the enablers, I would say the enablers are in place.
Nagesh, hi, good morning. Just a couple of, this is near term though. The last time we spoke, you said that B2B sales are under 10% of your overall volumes. Since then, when we've spoken with e-commerce companies, delivery companies, logistics companies, most have kind of pointed to a marked slowdown. Have you seen that in that side of the business for you?
Actually, B2B still remains a smaller portion of our business. And while we have stable customers who continue to do business with us, the idea of introducing an application-specific product, the NXU that we introduced yesterday, right, is to go after certain specific areas and customers that the applications will demand, right? So short term, we are not as dependent on B2B. So it's not affecting us because my retail and my distribution is growing and my B2C business is growing. But medium to long term, yes, we anticipate the B2B to be growing at a much faster rate.
Another thing you told us, Nagesh, was you were looking at potential acquisitions, M&A. Anything there? Anything has worked out?
So basically, again, several discussions in various areas. As and when the opportunity is right, we'll announce it.
Okay. Is the opportunity right in this calendar year?
We are working on several opportunities right now, as we speak, both India and global.
Okay, so working on several acquisition opportunities both in India and the global markets. Got that. You know, your electric mobility business is now about 46% of your overall revenues. How much do you think you can take it up to, say, by the end of FY24? What's the long-term strategy?
So clearly, Sonia, if you look at it, I think the potential is there where this will probably exceed our traditional business. And what I mean is our traditional engine business, right? So if you look at our run rate, where we have been over the last 12 to 18 months, I think, and if we anticipate the demand cycle to continue, we have done everything in our power to be ready in terms of products and manufacturing and supply chain and financing, right? So I think that's kind of what we see. We do hope that short term, the government has been very helpful with the FAME incentive as well as with the state governments pitching in. And we hope today the market penetration is about 4.5–5% EV as a percent of the overall two-wheeler sales. We hope at least until it gets up to about 10%, right, that this continues. And then I think the industry will be at an inflection point.
You know, Nagesh, you're saying that the e-mobility business is growing and even the age-old engines business was recovering. I've asked you this before. Since both the businesses are doing well, why not just separate both of them, demerge them?
Nigel, that's for the board to decide. But clearly,
is the board even thinking about it? Have you all, given it a second thought? You know, we'll talk to you more after your numbers. But in terms of a path ahead, FY24, FY25, since both the businesses are, recovering, one is recovering, the other one is growing, do you think it makes sense to separate it?
I mean, directionally, Nigel, I mean, there is a lot of deliberation on the board, nothing that I can announce today, okay. But definitely both the businesses are growing. You're absolutely spot on.
Okay. All right. So we will, of course, I mean, if that is the future, then at some point we'll wait by for some clarity on whether you separate the businesses. Just one final question, because this e-mobility business is something that has grown in the last 3 years. I think in Q1 of FY22, you had just 15 crores of revenues, and now you're sitting at 300 crores plus per quarter. What can you take this run rate to, say about 5–6 quarters down the line? Are you looking at 500–700 crores per quarter?
So I look at it slightly differently, Sonia. If you look at, and that's why I go back to the market penetration. Today it's 5%. of the two-wheeler market. If you get to say a 10% market, right? Ideally, in the next 4 to 5 years, people anticipate conservatively a 35% conversion, right? That gives you a good 6 to 9 million units, right? Depending on the size of the market in 5 years, right? So when you look at that, and we are a 13 to 14% market share player today, and we anticipate with our new products to protect and defend and grow our market share. So I think if you do the math, the numbers add up for themselves. So the overall, and hence the reason for adding manufacturing capacity and adding the products and adding some of this.
All right, we'll leave it there. Nagesh, great to have you with us. Appreciate you joining in with that perspective. Thank you and good luck. Well, 6 points lower on the Nifty. We're at what, 17,891. So it's not going anywhere. It's been clear from the word go. Well, on to our special segment, Quarter Se Quarter Tak, and we take stock of what one can expect from sectors as we get into the third quarter earnings season. And banking is what we are focusing on. Abhishek is standing by to tell us more. Abhishek, over to you.
Well, banking sector has seen one of the best loan growths in a while. The loan growth for the sector in Q3 FY23 has been around 17.5% YOY and about 4.2% quarter-on-quarter. So there has been business updates from few lenders which shows that private banks have witnessed strong loan growth momentum and they continue to take the market share away from the PSU counterparts. So RBI has been raising rates, so have the banks. Hence, one can expect the net interest margin of the banks to remain stable or improve on a sequential basis given the fact that banks have been raising rates on the lending side in this quarter. So asset quality will not be an issue. We may see improvement in asset quality with lower slippages and better recovery rates. So large part of the slippages may come in from the restructured book which is already known. Credit cost or provision for NPA divided by advances ratio will be lower on a sequential basis for majority of the players. Now, fee income can be the strong point this time around given the fact that loan growth has been pretty strong. We may continue to see private banks investing in their franchise, which may keep their operating expenses on the higher side. So the cost to income ratio could remain on the higher side. PSU banks may continue to see improvement in their profitability and hence improvement in their return ratios as well. Time for mid-size and small banks to report better return ratios than their larger peers in terms of improvement this time around. Hence, we may see a record quarter for the banking sector in terms of loan growth, net interest margin, low credit cost and low NPAs. Some of the estimates that we have from Kotak Securities is that they expect SBI's NII growth to be around 20% YOY and about 4.5% quarter-on-quarter, while they expect net profit for SBI to grow at 55.5% YOY and decline a little more than 1% sequentially. For HDFC Bank, Kotak Securities estimates the NII growth of 20.5% YOY and about 5.5% sequentially. On net profit, they expect it to grow more than 18% YOY and a little more than 15% sequentially. For ICICI Bank, Kotak Securities estimate NII to be up 24% YOY and close to 3% sequentially, while profit growth is expected more than 32% YOY and around 8.5% sequentially. For Axis Bank, Kotak Securities estimates NII growth of 24% YOY and close to 4% sequentially, while they are expecting profit growth of more than 46% YOY and a decline of little under 1% quarter-on-quarter. Back to you.
All right, Abhishek, thanks very much for that. Santanu Chakrabarti is India analyst, BFSI at BNP Paribas, is joining us now. Santanu, good to have you with us here. You heard Abhishek lay out the expectations. At a very broad level to begin with, do you expect earnings upgrades from here? BFSI was the only space in the second quarter which met expectations and in some cases exceeded expectations. What is your view for the third quarter?
Good morning. So, some of the points that Abhishek made clearly resonate with me as well. We remain fairly confident about the balance sheet situation. So the low credit cost part of the equation, etc., it should continue as is. Now, coming to credit growth, which has been the defining factor of banking sector performance, especially private banks, we don't expect it to slow down either in this quarter or going forward. The only place where we see that the next quarter in itself might mark the peak is in terms of margins. because most of the pricing benefits that we see on the loan side are about to come in either in this quarter or at most in the next quarter. And from that point onwards, both in terms of changes in liability structure, that is a tight CASA market, and maybe increased flow of fixed deposits, should ensure that cost of funds go up a little bit and margins could moderate a little bit next year out. That's our broad view on the sector and how we are looking at it.
All right, so that's your broad view. Wanted to understand in the private banking space itself, do you think there's more valuation headroom now? There may be sort of growth headroom, but on the valuation front, how are you looking at it?
So, Sonia, if we go back and look at private bank valuations in the context of, say, the last cycle as well, you'll realize that there is a part of valuations which is often ascribed to what the growth potential looks like. Because in private banks, high growth also means probably dilutions at a premium and therefore boost to book value through that. So from that point of view, looking at deleveraged balance sheets across corporate India and bank balance sheets which remain clearly powered to play into that opportunity, we believe that valuation headroom as the cycle takes an upturn remains there. The second part of the valuation nuance that I would like to bring in is that if you simply look at the valuation band chart of a bank, you might feel that we are at median and in some cases above median levels. But please understand that book values today mean very different thing from what book values would have meant 5 or 6 years or 7 years back, because we are looking at very clean balance sheets. So the equity with which we are working, on which we are computing the valuation, is a much more bulletproof number, if I might say so. So I think valuation headroom still remains within the private banking space. Of course, it differs by name and outlook of individual banks. But as a broad theme, I don't see any challenge to valuations of private banks, barring any large surprises on asset quality, which look very, very unlikely to me, as your analyst also pointed out.
Santanu, from a tactical, more trading kind of perspective, I'm sure you've got clients, the hedgy sorts asking you, which is the best play, around the earnings or into the earnings or post the earnings. Anything comes to mind out of the lot?
See, if we look at the, instead of going stock specific here, I'll try to outline a couple of themes which might be interesting from the next earnings season perspective. So one is that if you look at the texture of credit growth, in the beginning of the year, the only places or segments which were seeing growth for the large private banks was actually mortgages, unsecured lending. The common thread seemed to be these are all high, rather low touch, urban prime kind of businesses. As we neared the second quarter, and I think that momentum should continue into the third quarter and fourth, is that you'll see a lot of, if for the lack of a better word, high touch and NBFC adjacent kind of segments like SME, rural, agri, CVC. These segments will start to do well. So while credit growth will remain high, the relative weightage of segments might change going forward. That has certain implications for certain asset-specific plays within banking, and that's a tactical move that I think some hedge funds or other investment partnerships could look at from a tactical perspective.
Sure. We'll let you go on that note. Thanks a lot for joining in. And that's Kotak Securities with their expectations of the banking sector earnings. Let's slip into a quick break. On the other side of the break, we'll have Mitesh to talk to us about the market, which is sort of trending lower a tad bit. So it's sulking the index. The Nifty is now down about 30 odd points. Some technical trades coming up in a bit. Stay tuned.
Okay, welcome back. 50 points lower at 17,849. So this is the next leg down, which is starting to come through. I mean, broadly, the idea is to perhaps just let this phase pass, get more firmer kind of cues. And I think the big one is later today out of the US. Because, you go long at lows, the market goes up and then it sells off again. You're neither here nor there. So best to kind of once get out of this trading range and then look at least view on the index. Stocks, of course, are a different matter, and we've been highlighting those. Mitesh is back with us for exactly that. Mitesh, just a quick view on the Nifty and what are your trades right now?
So, Prashant, the index, as I said, will have a slightly stronger chance of breaking on the downside below 17,800. So I think you are seeing supply emerge at higher levels. But a short trade should be taken once we see an hourly close below 17,800. Then take a stop of about 100 points on the upside and look for 17,500 as the logical target. Having said that, on the stock side, I have one buy and one sell. Marico is something which is breaking down. It had red handle yesterday as well below the 200-day average, and today it's continuing. So that's a sell. Keep a stop at 500. Look for a target of around 475 to about 474. And the positive stock for the day is Larsen and Toubro, which I would recommend buying. Keep a stop below levels of around 2125. Look for targets of around 2200.
Another pocket that's doing very well this morning is cement. So you have the larger names, Ultratech Cement, that are up over 1%. There's Shree Cement that's up over 1%. And now even something like a JK Lakshmi Cement is also moving up with both strength on the volume and the price charts. So don't lose sight of that. Let's go across to Manisha Gupta, our commodities editor, to find out what she's tracking in the commodity markets. Manisha, over to you.
Thank you for that, Sonia. When I'm looking at sugar prices, which have continued to do quite smartly over the last couple of trading sessions, and we are back above 20 cents a pound into this one, not too far away from a 6-year low that we hit on 23rd of December, when the prices did go all the way up to 21 cents a pound as well. So markets moving firm. A couple of reasons for that. One is that you are looking at lower sugar output in Europe, and Europe is in the international markets shopping for sugar, as are many of the other Gulf countries as well. And then while the Thailand sugar output is expected to be strong, but the delay in harvest has been adding premium to prices there as well. When you look at the raw sugar prices, well, we have been jumping up for the last 4 years now. 2022 as well was a 4th straight year of gains coming in for the sugar prices. And when you look at raw and white sugar, we did see gains in the previous year, up by nearly 13% for white sugar and 7.5% for the raw sugar prices also. What the markets are watching out for is the Indian demand going forward now. This weekend is Makar Sankranti, and the sugar increase demand that we are seeing in the domestic markets is one of the supportive factors. And this is the weekend that you see the Indian wedding season restart as well after a gap of nearly a month. That also may lead to more sugar demand into the international space. Brazilian political unrest is one thing to watch out for. And then the fuel price policy in Brazil itself is something that the markets are looking at. That is keeping the prices jittery also. The Indian sugar exports, well, that is a strong number. 6 million ton has been allowed, but we do understand that while most of that may have been contracted, what the actual exports have been till time is 1.8 million ton. But the industry tells us that the rest of this quantity also will be exported by the end of March there. There's one thing that continues to keep putting pressure on sugar prices, and the reason that we haven't been able to sustain above 21, and that is the report from International Sugar Organization, which says that for 2022-23, we could be looking at a higher output by 5.5% at a record 182 million tons, and that could be putting some pressure.
Okay, all right. Thanks a lot for that, Manisha. Well, one of the metal stocks that's not reacting well today is Nalco. It's under some pressure. Kotak came out of the note. They've downgraded the stock to sell from reduce. So they've kept their fair value price unchanged at around 70 rupees. They see risk reward not favorable. Why is that? 3 big reasons. One is they're expecting earnings to be range bound over the next few years, as they're not seeing big upside for aluminium prices and persistent cost pressures in the alumina division. Point number 2 is they're expecting negative free cash flow for the next few years because of the big investments they're likely to make in the alumina refinery, which will be ratios dilutive. And finally, they're seeing valuation-wise, the stock trades at around 6.5 to around 7 times EV per EBITDA, which is not cheap. So that's why, in fact, that one is down 2% odd.
Okay, so that's on Nalco, but HCL Tech is the one that we look forward to later in the evening. Remember, HCL Tech mid-quarter scaled down their guidance, so perhaps we know what to expect. But Reema's here to tell us more about the expectations this time around. Reema.
Thanks so much for that. So today, HCL Tech is higher in the morning, but remember, over the last 2 days, the stock was under pressure. And as you rightly pointed out, the company had given an updated guidance just in the month of December, on 9th of December. So in a way, the cat is out of the bag. So the question is, can HCL Tech really surprise? So on 9th of December, that's exactly a month back, HCL Tech in its US Analyst Day had said that revenue growth for the full year is going to be at the lower end of their guided band of 13.5 to 14.5%. And this was on the back of higher than expected furloughs in BFSI, telecom and high tech. Last month in the Analyst Day, the company also reiterated its margin guidance of 18 to 19%. So the Q3 estimates have been set keeping this full year guidance in mind because the first half of the year is already done. In terms of the Q3 estimates that the street is working with, a dollar revenue growth at 3.5%, which will be higher than what peers are likely to report. EBIT margin expansion is going to continue like we've seen with the rest, aided by the rupee depreciation. So EBIT margins of 18.7% within the company's guided band, and profits will be up close to about 10%. If you look at the performance of the stock over the last 1 year, HCL Tech is down about 21%. Its valuations are cheaper than that of TCS and Infosys, but at 18.5 times, it's trading at a valuation multiple which is similar to that of Wipro. Back to you.
Right, thanks a lot for that. Well, the management of HCL Tech will brief the media in a post-earnings press conference at 6 p.m. later today, so do stay tuned in for that. We'll slip into a quick break. On the other side, Lata will get chatting with Anup Maheshwari of IIFL Asset Management to talk about what to expect from the markets and the top themes to bet on in 2023. Stay tuned.
Our market master today is IIFL's co-founder and CIO, Anup Maheshwari. And he's here because I want to discuss 4 specific themes with him. 1, why is equity a great asset class in India? 2, financials, are they likely to have a long, great innings in the equity market? And he argues, yes. Why is IT a compelling investment? And if possible, the 4th theme, PLI themes. But Anup, good morning and thank you very much for coming to our studio. Let me start straight away with financials because everybody is heavy on financials, but there is, last 3 weeks we have seen things recede a bit and there will always be self-doubt whether, we should continue to be so heavy on banks. But you tell us, what are your reasons? And you say you have compelling reasons to stay in financials.
Yeah, I mean, there are 2 ways to look at this, Lata. One is the here and now, and the other is just to put in perspective in terms of a journey over time. Let me just give you the second part first, which is, if you look at financials, over time we've seen within bank balance sheets, consumer lending is becoming a bigger proportion versus corporate lending. And if you just think about where India is in the consumer lending journey, we've come a long way in the last 10 years, but there's still a long way to go. If you look at, 10 years ago, the total retail borrowing as a proportion of GDP in our country was about 10% of GDP.
Yes.
Just to put in perspective, globally, when you look at retail credit to GDP ratios across the world, in most emerging markets, that ratio is anywhere between 30 to 50%. In most developed markets, it's between 50 to 100%. From 10% 10 years ago, we've come to about 20% today, but we're way below all averages. And what we've seen is consistently when per capita income rises, retail credit to GDP rises. So our thesis is that by the end of this decade, we'll get to 30% of retail credit to GDP. And this credit would be more dispersed across the population rather than it being concentrated only at the top tier, which is where most of today's credit goes. So it's a very interesting situation where credit growth is not only occurring, but it's occurring in a more distributed way, which will build overall per capita income rather than it getting concentrated only into the top 10 or 15 households. Our calculation suggests that the top 12% homes get 70% of India's retail credit today. So banks have really only touched the top end, but as they go further down, I think there's a lot of potential.
Yeah, I agree with you. It will be top, only 70% hogging the credit because at the moment, largely it's only the salaried class that is touched. So the EPFO numbers have perhaps been attended to, but not. But where will the mojo lie? Will it continue with private sector banks? Or do you think NBFCs, at the moment, NBFCs are so secondary to private banks or banks in general simply because the cost of money is much lower. Yeah. Do you think the mojo will be with private banks or?
So everyone has a role to play, honestly. I don't think it's just one versus the other. Over time, of course, private banks have shown the ability to increase market share relative to, let's say, public sector banks or NBFCs. But I think the key really in the longer run is to have a good liability and asset franchise together. And that's what's been supporting private banks. But all will exist because NBFCs have their own skill. And especially as you go down the population curve in income levels into tier 2, tier 3 and beyond, we call it India 2, India 3.
Yes.
The role of NBFCs is pretty important because they're able to reach out.
They have the last mile reach
Exactly.
much better.
And public sector banks are also important to the extent that a lot of deposit franchise comes for them from those areas.
Okay, okay. Point taken, but let me just add a quick, here and now question. Do you think that, the current situation, in the current situation, NBFCs have a problem? I mean, I'm just asking you a recent question because in everybody's mind, the way Bajaj Finance fell after it just announcing its numbers created a bit of a flutter. Is it that urban consumption has slowed now? And for the next 2 or 3 quarters, that might tell on everything, not just on consumer goods, on all stocks. What's the cause behind this sudden fall?
Yeah. So for Bajaj Finance, I think it wouldn't be fair to put the whole NBFC sector in the same bucket. I mean, Bajaj Finance obviously has been the best NBFC so far. And I think there are 2 currents here. One is the sector itself. The other is this general trend where more richly valued companies are generally, their valuations in today's day and age are just a little more sensitive to any earnings disturbance. And it's a great company, continues to grow, etc. But I think it's more a function of the type of market we're in. But NBFCs generally, our thought actually is that they've got a pretty decent time ahead of them. After all the trouble post 2018 to now, I think most NBFCs have reached a point, at least the ones that have managed to make it through, wherein balance sheets are a lot better.
Yes.
I think there is some confidence lending. You'll start seeing that incremental change coming through. And they've somehow managed their deposit franchise. It's not gone crazy yet. Yeah. So I think NBFCs also, and they're very reasonably priced now, a larger part of that segment.
And a newer crop of founders also. I mean, promoters like Poonawalla, Fincorp, Piramal. There are a new set of founders also who have come in. Take your point on that. But you're not worried about urban consumption. Is that something, a message that you got in the 3rd quarter advanced numbers?
Not really. I mean, you'll have these few quarters here and there. I think you've got to still look at the longer trend. And I think, as I said, penetration is still too low to worry about these type of issues yet.
Okay, let me come to the other big theme that you discuss, IT. IT is not the flavor of the day.
Sure.
But you have kept the faith, as I can see in your focused equity fund. What's your thesis there?
So just to clarify, I mean, we are slightly underweight relative to the index right now. Again, great bunch of companies, but we do see the immediate challenges ahead of them. The way we see it is, valuations have to normalize ideally. And most IT companies are maybe 10 to 15% above long-term averages still. So maybe we need a bit of a time play out for this. The commentary is the same, which is, worried about spending with the US recession, etc. But our sense is it is a 10% growth sector, beyond all of this thought.
Okay.
And if valuations come down, again, it's a sector definitely worth looking into. Okay. But the focus would be on the more larger caps this time around.
Okay. Any reason why?
Well, so a lot of the mid caps benefited in the course of the last 2 years when people were just desperate to do cloud migration. Yeah. Companies are willing to give contracts to everybody. Now we're going through, having done all the migration bit, now is the actual transformation. It's very easy to just do the migration, but the transformation tends to vest largely with the larger firms.
So the men from the boys would be seen?
They would tend to have a better business outcome.
Okay. Time permitting, I'll come back to wedding the IT and the finance theme. But PLI, which of them give you confidence? I mean, there's one school of thought which says that, it's very good to have incentives in manufacturing, but other ASEAN and North Asian countries can also give tax incentives. That's not a big deal. We don't have still the matching infrastructure to make a mark. But which PLI sectors attract you?
I think it's across the board. Again, Lata, what we really like about the scheme is they keep announcing new areas as well, incrementally. And it's something that not just the PLI scheme, as you correctly mentioned. I think there's again a broader trend where people are preferring to outsource from India now.
Yes.
And it's a trend that, to our mind, has become a bit irreversible. We've had many start-stops in the past. I think this time it's clearly visible to us that it will be of a medium to long-term duration. And this will be across sectors. Right now, one of the biggest areas of investments going on the export side is in specialty chemicals.
Yes.
I think that's a big area of capital investment right now. But from a PLI point of view, I think a lot of these consumer goods that we've been importing, we will now become a source of potential exports. You'll have other areas in hardware, telecom, at some point pharmaceuticals, etc., manufactured exports, industrial goods, just auto components. I mean, it's a long list.
Yes.
But the fact is, I think it's not just the incentive, it's the broader trend that's also supportive for the money going into the ground.
Okay. One more current question. We obviously were the outperformers of 2022, as your note to investors also points out. A 4% gain year on year for the Nifty index, where most other matching indexes actually were down about 20%. Now, that's not the story from December onwards, or more particularly mid-December onwards. Why do you think that this underperformance, is it all a China issue, that China is opening up and therefore people are going there? Or is there something else we have to worry about? And this is a near-term question.
No, there's no doubt, Lata, that over the course of last year, India's relative performance and relative valuation, more importantly, compared to the rest of the world, has moved to a much, much higher gap than the past. And we would expect some normalization. You can't be 2+ standard deviations above broader valuations. So we're seeing, China having got hit down dramatically, bouncing back. And we're seeing clearly from flows as well. Markets like Japan, Korea, Taiwan, China are seeing more positive flows. India's seeing a bit of a negative flow scenario right now. And this is very natural. Frankly, I think valuations adjustments have to happen.
It's just that.
I think so. From a global investment standpoint, there are multiple options. When other markets get too cheap at a price, everything.
And nothing in the earlier earnings announcements. I mean, full earnings haven't come, but advanced numbers have come. Nothing in that worries you that. Or is it a debt being a pull?
No. So from an earnings standpoint, I think there will be some downgrades. Frankly, we're looking at this quarter, next quarter being, a little softer than what maybe markets expecting. And then as we go into next year, and then of course we have an election year, I think things will slowly pick up again. But earnings are slightly soft. So there's that aspect, plus the markets are above average. India is one of the few markets in the world trading above average, long-term averages. Most markets are below. And therefore, there's a bit of this relative thing. So a good outcome, in our opinion, would be more of the same of last year from an Indian market perspective, which is a consolidation type of thing, with a bit of readjustment of valuations of businesses within the market. And that's good, because that ensures the longer term journey is more secular. You don't want a market moving up too fast and then creating a bigger downdraft later on because it's just so overvalued.
Okay. One, let me play to the gallery. Your overweights are industrials, financials, and consumer cyclicals. I mean, from what I could get. And energy, consumer defensives, and technology are not your, are your underweights. Give me one sector for 23 which you think could be a standout.
Well, on a relative basis, as I said, markets, frankly, we're expecting it to consolidate a bit. So I don't think anything does dramatically better. But I still think, in the first half of the year, financials will still probably do better. Okay. So financials, pharma is the, I can't say whether it works this year or not, but that's becoming more interesting for us just because of valuations there. Industrials, cement could be another interesting area. And generally, I think what we have to remember is as we go towards the end of this year, there will be a lot more focus on the elections. And typically 6 months prior to an election, you tend to start beginning to see a bit of an uptrend. So we'll wait and watch.
Okay. All right, and we'll get you thereafter to discuss those themes. Sure. Thank you very much, Anup Maheshwari, for discussing the medium-term themes that we should concentrate on when we look at equities. Wrap up on Bazaar. Chartbusters up next.